welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your co-host, Desi Troncoso. This is episode number 6. If you were with us on our last episode, number 5, Denny and Paul Winterroad reviewed portfolio loans and bridge capital, so make sure you check it out if you haven't already. In this episode, Denny and I will be going over the BRRR investment strategy. This is a great strategy to use to invest in real estate with both residential and commercial real estate. If you haven't already, make sure to follow us on Instagram and Facebook at Everything About Wealth. With that, let's go ahead and get started. Hey everyone, so how's it going, Denny?
Hey, it's going good. We're in Florida and it's hot, super hot.
And rainy.
Yeah, it actually has been raining almost every day. So we've been, we haven't been able to do our roofs at one of our properties.
Right. If you're an investor and you own some property and you need some work done, you definitely feel the weather right now because you're not able to get any of your renovations done.
Yeah, I think we signed the contract like 2 months ago and they still haven't been able to go in and do the roofs. So let's see what happens with that. But we just got back from our road trip.
Yes.
Yeah.
It was a great road trip.
Yeah, it was an awesome road trip. And that's probably the reason why we haven't been releasing as many podcast episodes. I admit it. We've been having a lot of fun.
Right. On a schedule, too. It's kind of like we pop out and they're like, hey, guys.
Yeah, exactly. But we're glad to be back in Florida, glad to be back to work, and ready to hit some goals in 2019.
Yeah, I agree.
All right. So what are we talking about today?
Oh, yes. Let's get into that. So we're talking about BRRR today.
BRRR.
Have you heard of BRRR?
Is that like a cat purring, like purr?
A cat purring. I don't know about a cat purring, but I thought of someone that's very cold outside.
Really?
Yeah.
That's what you think? Like
that's
Antarctica?
Like shivering, like BRRR. And I just, that's how the image comes into my mind.
Huh, yeah. Like snow, maybe. Yeah, I could see that.
Like snow. So it is an acronym. Some of you guys might have heard of it, maybe just recently, or you've known about it. I know for me, I just recently heard the acronym, but I've been doing what the acronym stands for, the investment strategy, for over 5 years. So we're going to just talk a little bit more about it. So if you do come across this and someone says, hey, do you guys do BRRR? You'll know what we're talking about.
Exactly. So let's get to it.
Yeah. So BRRR is spelled, just so that you know, in case you're wondering, it is BRRR. And so, Danny, you want to go into a little bit more about what each letter stands for?
Of course, I'll do that. So, BRRR, BRRR, stands for Buy, Refinance, or Buy, Repair, Refinance, and Repeat.
Right.
So, Buy, Repair, Refinance, Repeat. It basically is just a strategy. You find a property, you buy it, you repair it, you refinance it, and then you do it again. You repeat it so you can buy another property. So
you're basically building a portfolio this way because you're renovating, you're refinancing, and then from there you're repeating because you're using maybe the funds to purchase another property.
Yep, that's right. That's exactly what you're doing. You found, let's say, a house, right? And then that house is you're buying it for $100,000, and you need to do some renovations. Maybe you need to put in like $25,000 in renovations or $20,000, and the property after it's renovated, it's going to be worth $200,000. So then what you do is, instead of flipping it and selling it and making, I don't know, $60,000 or whatever the profit's going to be, $50,000, you go ahead and you refinance the property. You get a loan on it for probably around 75% of the value, and then you actually get cash flow from that. But now you have some money in your pocket, and you use that money to buy another property and do the same thing over again. And what this allows you to do, it allows you to start really building a portfolio of properties.
Right. And when you mean by cash flow, are they renting out the property? Is that how they're getting the cash flow?
That's correct. So you rented out that property that's now renovated. You put some money into, so you have really low repairs and maintenance taken care of because you renovated it. or you should have, right? Have low repairs and maintenance. And now that property is cash flowing and maybe it's throwing off somewhere around $250 a month, $200 a month. But more importantly, you're starting to build passive cash flow. And then over time, you can use that capital to buy other properties that also produce that same amount of cash flow. And then maybe you buy 10 properties. Now you have $2,500 a month in cash flow. It's a pretty good day.
Yeah, sounds like a great day. So where did this come from? Because again, I just recently heard of it, but we've been investing in real estate for over 5 years, and this is what we do. So where did this acronym start coming into mind, where someone was like BRRRR strategy?
Yeah, well, frankly, I personally first heard it like on Bigger Pockets, and probably heard it maybe 5 years ago or something like that. Brandon Turner mentioned it. But a lot of people talk about it. I think it's gaining more popularity now on the internet, on Instagram, and maybe in Facebook. People are posting about it. I just did a BRRRR deal. So it's really, even though people have been doing it for a while, we've been doing it on some of our houses and multifamily properties we've bought. But it wasn't marketed as the BRRRR strategy, right? Like it is now. So now it's a particular strategy. It has a name to it, and it's a great strategy to invest.
Yeah, and I think as time goes by, more people are becoming more aware as well of real estate investment strategies or investments, like you said, because of Bigger Pockets. There's so many resources out there that maybe there's just a lot more people aware now and are having the conversations more than before. And I think maybe that's what's also going on with that as well. That's
right.
So you talked a little bit earlier about using BRRRR as the flipper. But if I am an investor that has capital and I'm wanting to be a private lender, how does the BRRRR strategy work for me if I am lending money to someone that is wanting to do the BRRRR strategy?
That's a great question. In the end, if you're a private investor, you have capital that you're going to be lending on a property. We're talking about a house here, let's just say, single-family home, and they're buying it for $100,000, and the property value is $200,000. They need to put in $20,000 for renovation. They're going to pay you an interest rate to borrow your money, and maybe even some points, depending on how that works, how you guys negotiate that. But you're going to be getting an interest rate while they do the renovations. It could take 3 months, it could take 6 months to do those renovations, and then refinance the property after that. So within that period, maybe you're earning 12-14% interest, 10% interest, I don't know, whatever your market rate is in that area, so you can stay competitive. And then that's a pretty good day, a pretty good return outside of the stock market, a return maybe diversifying your portfolio, and a return that you can do it again in 6 months and then earn another 10-12% over those 6 months. So you have your money out there moving, and then with the points, maybe you can get a return higher than 15% or something like that. There are some things to consider, though, is to make sure that person that's buying the property, number one, that you have some comparable properties that have sold in the area. And appraisal would be the best thing, that if they renovate it and they do X, Y, and Z, they do these renovations, the property is going to look like this, that it's really going to be worth $200,000. Because the worst thing would be that after they renovate it, it's really only worth maybe $150,000, and then maybe they're not going to be able to pay off the loan in refinancing. They may need to sell the property, and then that if that's the strategy as a backup, they need to be able to plan for that. How long is that going to take? Maybe you need your money within a certain amount of time. So you want to take those things into account.
Yeah, that was my question. So as a private lender, my goal is to ensure that the property because their goal is to refinance, right? Mm-hmm. Which means I'm getting my money back at that point, because they're able to refinance maybe through conventional or other mortgage terms. So as a private lender, I see this as a good strategy because I'm able to get my money back maybe within 3 to 6 months, depending on what their goals are. You talk more about that. And then I can get my cash back. And then once I get my cash back because they refinance, I then would do it again maybe with someone else or the same person, right, if they find another house already. So that's really what I'm doing as a private lender, right?
Yes, that's exactly what you're doing. And like you said, you could do it again with another person or the same person would be great, because now you have a good relationship with a person that has some experience, and they're going to be going back to you because maybe you have some competitive terms, you guys work together. Sometimes it's just easier to do business with the same person. There's trust there, and you already know how they work, and they're reliable. So as long as you're reliable, you have the capital available when they need it. If you don't, just tell them. But when you do, you come through and you close the deal, and then you earn a fair rate of return, and they make their capital. That's a great day. One other concern as a lender that you should definitely take into account is, does the person have experience renovating properties as well? Because if they don't, the renovation will take longer, or maybe the property wouldn't be renovated as it should, so that'll reduce the value. Or in a worst case situation, if they didn't buy right, the property may not be worth as much, or it will just sit there, so then you maybe have to foreclose, etc. So those are all things to take into account if you're lending.
Okay, so those are some of the cons, I guess you can say, that go into possibly doing that as a private lender.
Yep. As I would say, as the risks.
Yeah,
right?
of course, the risk of it. So in the benefits, I know we talked a little bit more about the benefits, but just to make sure that we understand and we summarize, the benefits are really getting your return, and it seems to be in a shorter time frame. You're getting your money back, which we all know, the present value of money. So you're able to get it back within 3 to 6 months if it's done correctly, because they're able to refinance out. And at the time, you're earning your interest points, and also, what other fees you may have as a private lender.
That's correct. Can I just talk about one more con?
Yeah, go ahead. Please let us know.
One more con about this, the BRRRR strategy, I think it's a great strategy to buy property. But just like anything else, there aren't 100,000 BRRRR properties out there for people to be buying every single day. It's a numbers game to find that the right property to buy. And as a lender, if you're looking for people, you can lend on flips all the time, but if you need to be cognizant that also lending privately, you have to continuously find a new deal to keep your money working. So you really need to build a relationship with several people that are doing it. And so you don't have your money in your account and not earning any interest, because then you actually could end up getting a lower rate of return than you would have in other ways. So.
Right. And I think that's a great point, because I think a lot of times people think as a private investor that you're passive, and it's not that way. And I really try to harp on that you need to understand the fundamentals still of real estate investing and how to analyze properties. So you can make sure that you are still investing in a good deal as a private investor. Just because someone comes to you and says, I have this deal, it looks great, you can't take their word for that. You still have to understand, okay, what are the comparables? You have to ask them for that. You have to be able to analyze the area and see whether or not, like they're saying, they're going to get that money back as if they're trying to project to you. And I just think as a private investor, you should also understand, like you're saying, the risk, just in case it doesn't happen that way. And make sure that you're set up with your legal documents or whatever way you need to structure your business, which we recommend speaking to an attorney with
all
that.
the time.
So you can make sure you have the right things in place for you, so you can really try to mitigate or lower those risks right at that time.
That's right.
Very good. Well, we've talked a little bit about how it works with residential, but as we all know, what gets me excited is commercial real estate.
We know it.
Which is my favorite type of real estate. And I just want to go into more about how does BRRRR work with commercial real estate investment properties. That's kind of what we like to focus on. For anyone out there that's more in the commercial real estate, especially, which is the sexy thing right now, which is multifamily property. How does it work for the investor in using the BRRRR strategy, or maybe working with a syndicator, right, in commercial real estate?
Well, if you go back to houses, when you're buying a property, you know what it's worth today if it's renovated based on comparable sales that are in that market. If a lot of properties are selling for $200,000, and if it's houses, then your property is probably worth around $200,000, more or less, depending on what the fixtures are and the size, etc. So if it's a similar house, it's going to sell for similar. But the good thing with commercial is that the property, even though things are selling commercial properties sell because of the income it produces. So if the property produces more income, then it actually could be worth more. How does this come into commercial? We're doing the same BRRRR strategy. We're buying a property. It's maybe worth, commercial property is a little bit more money, but let's say it's worth $1 million. And we're going to buy it, repair it,
raise the rents.
Raise the rents could be also the second R for commercial. Raise the income, reduce the expenses. It could be another R. So any one of those could be renovate to increase rents, renovate to reduce expenses, and then you refinance that property. Maybe it's going to be worth $1.5 million or $2 million. See, easy math. So now you have that property. You're able to refinance, and then you're able to pay off the loan that you originally got. But now if you're buying commercial property, typically it works with JVs, so it's like syndicators. So you're buying as a partnership, you're an owner now. So you get your money back, or part of your money, or all of it, and then you still own part of the property, you still own part of the cash flow, and you get a great return on investment, because what's your return on investment if you don't have any money in the deal?
Right, infinite.
Infinite, baby.
Yeah, and I just love this strategy because it has worked for us, and we're going to talk a little bit more later about how this has worked for us. But it really is amazing to see where you can get into a property, you can raise the value of it, and later down the road, because a lot of times with commercial properties, the mortgage terms are like 3-5 years, right? So you need to refinance a lot more than a residential property. But you're able to go in, and then if your property's value has increased, that difference, like you said, $1 million versus 1.5, you're able to get that 500. It goes, of course, into closing costs. But anything that you received in between that, you're able to pay off investors that have, give them back their capital they put in. And at that point, which I love, they're still getting a return.
Yep.
Because they're a part of the ownership of the property. But because you gave them their money back, then they're able to do the next property with you now.
That's right. Exactly.
So I really love that strategy, and you're able to hold on to the property. It's still cash flowing. And then, like you're saying, you're just repeating it, where now you're going into another property and you're trying to do the same strategy as well. So I really do like this and how it has worked. So we understand more of the benefits is because it has a private, right, they're capital investors. From the capital investor side, you're getting your money back. And at this point that you have put in, maybe you JV'd, or maybe you're working with a syndicator, and then you retain your ownership in the deal at that point. So like we said, it's infinite, right, your return at that point. Are there any other benefits you can think of in this strategy that I haven't really gone over?
Well, I mean, you're going to get all the benefits that come with owning real estate and commercial real estate, like depreciation. So you're going to be able to reduce your taxable income if you need to do that. If you're in a high-income tax bracket, you want to use depreciation to do that.
Talk to your accountant.
Yeah, definitely talk to your accountant. But now you mentioned a great one. Now you have more capital if you to invest in the next deal. So you're earning money on this deal, but you don't have any money in there, which is great. But then you can buy another deal with that same amount of capital. So now you're magnifying your cash flow. You're using your capital in such a wise way. Imagine, you could build, hundreds, if not thousands of units over such a shorter period of time when you own those properties. And then the best thing about it too with multifamily or commercial real estate is, as an investor, as a passive, capital partner, you don't have to continuously look for the next investment necessarily. Like, let's say if you were a private lender on a house, so in our example with the house, you have to continuously be looking for flippers. Now your money's working, you're earning a return on that. Now you got it back, you have your money, but you're still earning a return. The next deal, maybe a syndicator, et cetera, is gonna do it, or you could even lend it privately again. So now you have both. You get to, like, what is it? Have your cake and eat it too, right?
Yeah, because usually whenever you're investing in a commercial real estate, it's for a longer term than a house, right?
Exactly.
The house is someone's trying to refinance within 3 to 6 months. In most cases, of course, I can't speak for all properties. It depends on the strategy. Usually, to refinance, there's a longer term, maybe 2 to 3 years, maybe 1 year new development, really depends. But it's not this like every 3 to 6 months you're looking for someone new to lend money to.
Exactly. I mean, very few scenarios are that short. Think about at least a minimum of a year, maybe in another case a little bit longer, like 2 to 3, 3 to 5. It depends on the deal.
Okay. Now, we have all the great benefits, right? I'm ready to do this, right? Are there any cons or concerns I should have?
A concern that you definitely should have is over-leveraging the property. So what does that mean? That means when you're actually refinancing the property, the loan shouldn't be too high. Maybe you want to stay on a loan to value around 70%. And the reason behind that is because the higher the loan, the lower your cash flow is going to be. Mm-hmm. So you want to make sure that you're still going to be having enough cash flow to pay the higher debt, pay capital expense, have a capital expense reserve, have all these things that you need to have, and make a decent amount of cash flow on your money. So even if it's an infinite return, what are you earning on equity? Right, because you have money in there that is not profitable, and this goes even into the flipper. That's something you need to consider with BRRRR. There's something called return on equity. You can look up the formula online, but it's basically what are you earning on the amount of money that you're not taking out of the deal, and what could you be earning on that money if that money was outside of the deal? And you need to take that into account, put it into a whole basket of benefits like the depreciation, the return on your money, not having to deal with managing the day-to-day of the investment. You're definitely informed, educated on what is a good investment, reviewing the monthly reports that your syndicator is sending, reviewing, asking questions at the quarterly meeting. Make sure that things are being done correctly, but you're not having to run the day-to-day and work with the management company or nothing like that. So
yeah, and I think that's a great point. As I stated earlier, as the capital investor, you still want some form of involvement in the deal. So what I would say with this is a great time to have good communication with whoever is running the deal, whether it's a syndicator, whether it's a JV, however it's set up, that you make sure they're not going to over leverage when they are doing that refinance. And if you see that the numbers aren't going to work, that you voice your opinion at that point to make sure that the property doesn't get run down because cash flows now are lower because the debt went up and you're not able to maintain it after that because you still have expenses. You still want to give out, right, the ownership distributions, thank you. And then you also want to make sure you have enough for reserves too. So I think that's a great point, and I think making sure you have that relationship and you understand what's going on with the property could help with that as well at that point.
Definitely.
Now, why would someone want to use the BRRRR strategy instead of just selling the property?
That's a great question, Desiree. Well, there's different ways. They want to own cash flowing real estate. They want to own an income stream. That's what you're buying when you're buying real estate and a lot of other investments. You're buying an income stream, something that's going to generate cash flow to you over a certain period of time. Most investments. Some investments, people are thinking, I really don't need the cash flow, and that's the investor you need to worry about. Need to evaluate what type of investor you are. Are you looking to build cash flow, or do you have great cash flow from a business that you're earning a good amount of money from that business? You really don't need cash flow. You want to build wealth into the future, so you're looking more for capital appreciation.
Yeah, and I think because a lot of time it depends on your investment strategy too, right? So like you said, someone may want to build their cash flow, but someone may just want to build their cash. So if you're someone that just wants to build cash quickly, then you can sell and then take that cash and do whatever you want, because maybe they want to buy a business, maybe whatever they want to do with their investment strategy with it at that time. They may want to sell at that point. Or, other things that might go into it are the 1031 exchanges, right? May also go into that as well. But again, it's just, I think the investment strategy that will depend on the person and what works best for them. Mm-hmm. Like BRRRR is just one of many strategies.
Yep, I agree.
Very good. Well, what I would like for us to do, because I know a lot of times people are like, yeah, this is great information, but how does this really work in the real world? Because you always give examples, right? And people try to define what it is. So The most exciting part of the podcast is us going over how we use the BRRRR strategy in one of our multifamily properties that we still currently own till today, right?
Yeah, we do.
All right.
And this was our first property that we did on our own. So we partnered on our first deal with another syndicator. We learned a lot of the right things to do. And then we found our property, a 24-unit apartment building in Florida. And we use the BRRRR strategy with that property. And the way that we used it was we found a property that needed value add potential. In commercial real estate, anything that you can increase the value is called value add. And then value add is you're doing two things. You're either increasing the income or reducing the expenses. Properties, they have income, they have expenses, just like any business. And then the more income that it produces, the more net income it produces, the more the property is worth, the higher the value.
Right.
So what we did was we found a property that needed, that had some more excess expenses, some expenses that were higher than normal. The operating ratio was maybe closer to 50%.
Lower rents in the market.
And lower rents in the market. So we ended up finding a way to get the property down to maybe 37.5%, 38%. The operating expense ratio, so the expenses went down. And then we were able to increase the income, probably increase the income by about $30,000 a year and reduce the expenses by the same amount So a total increase in net operating income of about $60,000 a year. The property is about a 6.5 cap right now. So the value went basically it went up. I would say in the excess of at a 6.5 cap, 60,000 divided by 6.5. That's about $923,000. So what we did was we increased the value. And then we had the property appraised, and the appraisal came back at the higher value, which was great. And they even nicked us a little bit because they got the taxes wrong, right? The appraiser, freaking crazy. But they don't give you the appraisal until basically the day of closing, and they messed up with the tax. So we actually could have borrowed more if we wanted to, but we really didn't want to borrow that much more. We got a loan for 70% of the value because we wanted to keep the loan to value low. And we were able to take out close to $300,000 in cash from the property. We had originally invested $192,000. So we and our capital partners, they got their money back that they had invested. And then we were able to distribute another $100,000 or so to the capital partners. Because, we also, sometimes you use that money also to put maybe into future reserves if you need it. But we had some reserves, so yeah, it was a great day.
Yeah, it was a great day. And, that property has been operating so well since we've owned it. But we definitely got that property. And the story behind that is it was inherited by a family of brothers and sisters because the father passed away, unfortunately, and they really didn't know how to operate the property. So there were, using vendors that were charging them double of really what something should be. And then also they weren't able to fill up the apartments because they didn't really understand how to market it. And then they had free cable. So they had all these things that were just really not operating the property to its best, its max, right?
Mm-hmm.
So they were just wanting to sell it off because they actually were more in agriculture, I think it was. They were wanting to buy land, right? So we were able to talk with them, and we met with them, and we sent them a letter, you guys. And we were able to come to an agreement. It took us about a year to close on that property. So patience, a lot of patience.
Yeah, especially with bigger deals, right?
Right, can reap great rewards. And as we tell people, this isn't, everybody thinks they're going to get into multifamily, they're going to close on a property like next month. It just doesn't work that way. It takes a little bit longer. You have to find the property, you have to analyze it, you have to negotiate. So that has been a great property that we've had, and we're happy that we can share that experience with other people so they can also possibly do that with their investments in the future as well.
Yep. And the property itself, that allowed us also, when we also spent money renovating the property. So we replaced old HVAC units, we replaced old water heaters, we redid the parking lot. We spent a lot of money on sprucing up the property, and all those things helped with the new valuation. The tenants are super happy. We've painted the property. They love the property, how it looks, and the way it's been taken care of. And the way that we've been doing that is because the property's operating like it should. And that makes a big
deal. You have the right property manager too.
Yeah, and I think that in the end the story goes, if you find if the property's operating like it should, you could put the money that it deserves. But if you can't, then you're kind of shortchanging your property. You're not earning the income that it could earn. So that's something that you also need to consider, and I think it's throwing off somewhere around $4,000 or $5,000 a month in cash flow. So that's also something to take into account when you're doing the BRRRR strategy. Make sure the refinance, you keep the LTV low, make sure you find the right property, and make sure you put in the right amount of money back into the property, not just take money out, right? Because we've seen a lot of people take money out and then the property looks terrible. So
Right. Yeah, you definitely don't want to be a slumlord. I think that's the fastest way to lose money. And people think they're actually making money, but you're losing money because the value of the property is going down because you're not taking care of it. Your tenants are going to notice you're not taking care of it. They're going to leave. You're not going to be able to get the rents that you should get. And the property, it's just... You're going to have to fire or sell it, and that's when Denny and I come in. You don't want to be that person that we're buying from.
Yeah, and then and you definitely don't want to be that person. But also this gave us a little bit of a window by doing the BRRRR strategy to increase the income of the property, to increase the rents some more over time, slowly, to let the market develop a little bit where it has within the last couple of years. And then now that that's happening, the property value has gone up even further, where at this point, we're considering selling the property sometime in the near future and buying a bigger property or doing some different types of deals. So if you're a buyer out there, contact us because we're going to be putting it on the market soon.
So one question I know that people may have out there that I just thought of, I know I would, as someone that was getting into it, what is the time frame of when we bought it and we refinanced it?
That's a great question. So it was almost 3 years that we took from when we bought it to when we refinanced it. I think it could have taken a little bit less. It could have taken maybe 2 years. So we were trying to work out the financing with Fannie Mae and Freddie Mac, so that's why it took a little longer. Initially, they said Freddie Mac, they said that they could do loans for less than $1 million. Guys, I haven't found one. A lender that wants to do those small balance loans. This was a small property, so the loan amount was like $1,050,000, and they thought it was gonna appraise a little lower, and the loan was gonna be under $1 million. And frankly, they just don't want to do it. So with Fannie Mae, Freddie Mac, so if you can find someone, great. I don't discourage you, but we just haven't been lucky enough with our relationships. But I would say look for a community bank that's going to do the same thing.
And why were we refinancing at 3 years?
Because we got originally our first loan was with a community bank, and we decided to get a 3-year loan because it was going to stay fixed for 3 years. And actually, after that, the loan ended. We would have to refinance with that bank and get a new loan with the lender. But instead of going with our community bank, we actually got better terms, a longer amortization schedule, better interest rate by going with Freddie Mac, and that just allowed more cash flow of the property and even I think more cash out too, maybe even than we would have been able to do.
And the last question I know people would want to know is, why did we refinance instead of selling?
Well, I kind of answered that a few minutes ago, and it's because we believed, and it kind of has held true, that the market still had some movement to grow. And we also, at the time, we didn't have an investment. We with the cash that we were able to get out of the property, we had enough cash to get our next investment. So we didn't really need all of the cash right away in our particular situation. But now that we've purchased another property and we use that cash, and some of our investors also use their cash, so we purchased a 32-unit property. So we've used a lot of our cash for that acquisition and some others. So now we want to find different acquisitions, and I think it's held true. Like a Publix went into the area that wasn't a Publix before. If you're not from Florida or from the Southeast, Publix is a higher end grocery store, similar maybe to Kroger or Sprouts, but so they went into the area and they've been talking about Publix for so many years, and it was something great to see that, and that actually brings up the neighborhood. There's Taco Bell's going up. There's other things like that going up.
Yeah,
So
a lot of renovation and other retail around the area as well are going up. So definitely changing the community there. So.
Exactly.
Well, I think that's all we have for today, right? With the BRRR strategy.
Yeah, I hope everyone got a lot about the BRRR, and and they use it to do their next deal, or find a syndicator or a flipper that's doing it and that you can partner with.
Yeah, and I think that's always a great idea, especially when you're first getting into the investment and you're not really sure where to go. So great advice. Thanks for tuning in. I hope you enjoyed the episode about using BRRR as an investment strategy and are able to use it in your future investments. To learn more about real estate investing or how to be a private investor capital partner, visit our website at www.everythingaboutwealth.com. If you like the show, make sure to subscribe and like us on iTunes or your favorite app. With that, see you on the next show.